In this last video on bond valuation, we'll explore a few more return calculations, talk a little bit about understanding the riskiness of bonds and how that works for us. So the third measure of yield, if you will, is really for investors who actively trade their securities, or for investor that has a specific time frame involved with investing. So let's assume that you need $100,000 in 10 years, right? So you can buy bonds that all mature in 10 years. So you'd be guaranteed that you buy 10 of those, you get 100,000. But maybe you buy 30-year bonds because the yields are better. So we need to have a way of calculating, what will the bond be worth 10 years from now? So we're going to have to predict a future interest rate. Again, coming back to this prediction idea, and basically say, look, if I buy it today, and if interest rates change to a certain point, and the value of the bond changes in the future, if I buy it at this price today, what return will I get on this investment? Sometimes this is also called the realized yield, right? Because it shows what you would realize by trading in and out of a bond itself. Again, because we are forecasting interest rates, there is some uncertainty with this analysis, but it certainly it's a viable strategy for investor to buy a long-term bond because of the coupons are higher, the yield might be higher, but we don't want it for 30 years. We only want it for 10 years or 5 years. So in our example we've used before, right, let's assume that we think interest rates in 10 years are going to fall to 8%. So what will the value be in 10 years? Well, we need to change the numbers, or we just need to change the yield to maturity here, right? The time to maturity. We have to change this to 10, right? Because it was 20, and now in 10 years, there'll only be 10 years left. So the value is $1,100.65. So that's what we predict the price to be in 10 years. So now we have to come back, put the numbers back to where they are. So backward to time to maturity of 20 years here. And now we input that number here. Here's the expected future price, $1,160.65. And the year to the sales, 10 years. So in 10 years, this will be worth, the yield to maturity in 10 years, or the realized yield to maturity, is 11.21%. So essentially that's saying, look, if you hold this for 10 years and interest rates change where you think they'll change to, you should earn roughly 11.21. And in the original bond, all we wanted was 10. So this is a good bond investment, whether we hold it to maturity or we sell it in 10 years, or if it actually gets called in 5 years. All of those things create a higher yield than what we were really interested in based on the riskiness of similar bonds. So if you're thinking about valuating a bond, right, conservative, income-oriented investors focus on yield to maturity. But more aggressive investors are going to want to do this realized yield to maturity, mostly because they don't plan on holding till the bond actually matures. Now, what we also have to be concerned about, if you're buying in and out of bonds, is you have to be concerned about short-term capital gains versus long-term capital gains. So holding a bond for less than a year is going to create a different tax situation than holding a bond for 5 years or 10 years or 30 years. So we want to talk a little bit now about risk. And in general, the risk we're talking about is interest rate risk. So we have a statistic that we can calculate. It's called duration. Duration is a measure of bond price volatility. What happens to price as interest rates change? So it's going to capture two kinds of risk. It's going to calculate for or take into account price risk, which is the changing value, and also the risks of changing reinvestment opportunities. It looks at both of those risk factors. So it's an improvement over yield to market because it looks at reinvestment risk. So it compares the sensitivity of bond prices to interest rates. A way to kind of define bond duration, it's the average amount of time it takes to receive the interest and principal from payments. So it's a weighted average, if you will, of the calculations. And the formula itself is quite complicated, but easily enough done with a spreadsheet. So again, before we get to the actual numbers, let's continue talking about what duration means. In general, so if you think about duration and the impact it has on prices, right? Higher coupon bonds have shorter durations. So that means they are less sensitive to changes in interest rates than lower coupon bonds. Longer maturities have longer durations. They're more sensitive to price changes. Bonds with high yield to maturities are going to have shorter durations. So the higher the return, the shorter the duration, the less sensitive the bond is to interest rates change. And again, these variables, right, coupon, maturity, yield, they interact to create this ultimate number called duration, right? So the shorter the duration, the less volatile the bond prices will be. So here's our formula for duration. It's the sum, right? So you have to take the present value of the cash flow each period, divide that by the bond price. And then each period you multiply that by the period. So the very first year would be the cash flow year 1 divided by the bond price times 1. Then the next one would be the present value of the cash flow year 2 divided by the bond price multiplied by 2. And then you add those all up. That is what is referred to as Macaulay's duration. Now the number that we want to use is used so that we adjust for some upward bias. So if you divide the duration by 1 plus the yield to maturity, that provides something called the modified duration. And what that does is this Macaulay's duration has a little bit of an upward bias with respect to the measure of risk. We want to adjust that somewhat. So if we look at this example that we've been talking about, right, here's this bond that we've been discussing, and here are the duration numbers. 9.67 is Macaulay's duration, and modified duration is 8.77. Now, if interest rates change, if they increase by 0.13%, what will happen to the change in value? So if you include here 0.13%, the percent change in value should be negative 1.1. So the new price will go from $9.35 to $9.24. We know it's going to go down because when interest rates go up, bond prices go down. Spelling mistake. So hopefully that describes a little bit about what's happening. Now, beyond this class's understanding, right, beyond what we really need to know, the actual relationship between prices and interest rate is not a straight line. And the modified duration and these duration numbers actually assume a straight line relationship. Convexity is a number that measures the effect of the curve. So that number is incorporated into a formula. And I don't have the number here. It's not that it's important. But if you plug these numbers in, you also see a space down below in the worksheet where it talks about the change using convexity. So it will have an impact, obviously, on the change in price that is predicted. So what about duration and price volatility? Duration helps us understand how prices are going to respond, right? A bond's duration can be used as a viable predictor only as long as the yield swings are relatively small. So if you're talking about a 2 or a 3% change, duration loses its ability to give us a precise answer, if you will, right? As interest rates, as long as they are low, we shouldn't have a problem with understanding how interest rates and prices will relate with each other and ultimately change. How financial institutions use this is through something called bond immunization. So what immunization allows us to do is it allows us to control and understand price and interest rate risks in general. So we want to offset the challenges of risk. So just to come back and review, price effect or the price risk is the change in bond value caused by interest rate changes. So if interest rates go up, bond prices go down, that means the price effect would be negative, it would be bad. But the reinvestment effect talks about the change in income in the future of reinvesting interest rates or coupons as interest rates in the economy go up. So if interest rates go up in the future, our future coupon payments will be reinvested at a higher rate, and that's a good thing. So when interest rates change, there is both a negative and a positive effect on every bond in existence. So bond immunization is a technique to try to find a way for price effect and reinvestment effect to be equal. So they are equal but of opposite signs. And this really doesn't work for a single bond at all. This only is effective if you're thinking about a bond portfolio or some kind of an investment strategy like that. So what kind of strategies can we have with bonds? Right, since excuse me, we need to understand something about changing interest rates and prices, right? So a passive strategy basically is, we're not going to really think too much about what's going to happen in the future, right? Typically, we're just going to buy and hold. That's a passive strategy. So we're not going to generate transactions costs, right? So there's several different methods, if you will, of passive strategies. One is called bond immunization. We've talked a little bit about that. But how you ultimately would do this is you would pick a time horizon, let's say 15 years, and you want to have the duration of your bond portfolio to be equal to the immunization, to the investment horizon. Buying and holding, replacing bonds as they mature, is basically what, or when quality declines, is a buy and hold strategy. So even though it's passive, there could still be some active changing. Certainly when bonds mature, you want to replace them. But if quality declines, you also want to change them. Now, bond ladders are something that are kind of interesting, right? So essentially you create a portfolio that has bonds that mature 3, 5, 7, and 10 years into the future. As the bonds mature, so in the 3 years when this bond matures, then you would take that money and then you would buy a 10-year bond. And you would keep that rotation going. So essentially what this do is it might provide some higher yields on the longer term bonds, and it'll give us some dollar cost averaging benefits as we think about trying to manage the overall changes in prices over time. Maybe we want to trade on interest rates behavior, right? So we need to have a forecasted interest rate approach, right? Essentially, this is all about market timing. So investors want to increase the returns on their portfolio in anticipation of interest rate changes. So they're going to seek capital gains when they think interest rates are going to decline. Because if you think interest rates are going to go down, prices will go up. So if you think interest rates are going down and you're predicting prices are going up, you're going to want to make sure you have bonds that have relatively high durations, because they will move the highest. If you want to seek preservation of capital, right, then again, you're going to anticipate increases in interest rates. You may also, again, want to move into certain kinds of duration bonds in order to preserve your capital. So most of the trading that you do with respect to this type of thing is with investment grade securities, because obviously those the certainty of the cash flows is going to make investing in general a little bit easier with those. There are things called bond swaps. This essentially occurs when you sell one bond and simultaneously buy another bond in its place. Well, why might you want to do that? Well, they have similar risk, but you want to increase your yield to maturity. You want to take some advantages in interest rates, improve the quality of your portfolio. Maybe you just want to do it for tax purposes, right? You sell something that's at a loss so you can get a capital loss, and repurchase a similar bond so you're still invested in the bond market, but you get this this tax benefit, if you will, for the sale, the capital gain sale of a bond. So these have different names, right? A tax swap is what I just described. Substitution swaps, profit takeouts. But they're all involved, right? They're all used to help find better ways to increase portfolio performance. So a yield pickup swap, again, we kind of talked about this a little bit more. An investor switches out of a low coupon into a comparable high coupon to realize a pickup in current yield and yield to maturity. So this happens because the yield spreads that normally exist, right, they might have changed, right? So we know that there's this existence, right? We have to be careful about transactions costs, but we do know that similar bonds should have similar rates. This yield spread, right, the difference in returns, it should be fairly stable. If that changes a little bit, we might be able to gain some value. And again, selling a bond that's declined in value to get the capital loss, it's a great way to maybe reduce some current income, but still keep a bond investment. Now, the thing that we have to be aware of here is something called a wash sale. A wash sale would be buying the new bond and it being an identical issue to the old bond. And the IRS will not allow you to take those capital losses if really all you did was change the certificate number on the bond, right? So again, these swaps are ways to actively manage a bond portfolio. So that's the end of the bond valuation chapter.